What are the top 5 tax deductions for your LLC? Any state recognizes the limited liability company as a legal entity. The LLC was born out of the desire for business owners to have a business structure that allowed them to operate as a traditional partnership. Their goal, as with the corporate business form, was to distribute income to the partners who reported it on their individual income tax returns while also protecting themselves from personal liability for the business's debts, unless the business owner forms a separate corporation. The owner and any partners, if any, assume full responsibility for the company's debts. However, under LLC rules, an individual isn't liable for the firm's debts if he or she didn't personally guarantee them, such as with a second mortgage, personal credit card, or putting personal assets on the line. In comparison to subchapter S corporations, the LLC has a number of advantages. S corporations, for example, can only issue one class of company stock, whereas LLCs can offer multiple classes with different rights. Furthermore, S corporations are limited to 75 individual shareholders, all of whom must be U.S. residents, whereas LLCs can have an unlimited number of individuals, corporations, and partnerships. In comparison to a limited partnership, the LLC offers significant tax benefits. For example, unless a limited partnership partner takes an active role in the business, his or her losses are considered passive losses and cannot be used to offset active income. However, if a partner actively participates in the firm's management, he or she becomes liable for the debt. It's a no-win situation. An LLC's owners, on the other hand, are not responsible for the company's debts, and any losses the LLC incurs can be deducted from active income. However, in exchange for these two significant benefits, LLC owners must pass the transferability restriction test, which means that the LLC's ownership interests are not freely transferable. Because of this limitation, the LLC structure is unsuitable for large corporations. Corporations must be able to easily transfer their corporate stock on stock exchanges in order to attract large sums of capital. This restriction, on the other hand, is less of a problem for smaller businesses, where stock ownership transfers are relatively infrequent. Luckily for you, Laptop Lifestyler, today we will discuss the top 5 write-offs for LLCs. Now, there could be a number of reasons why you decided to start an LLC. Maybe you're a new business owner. Maybe you just started earning $2,000 income, and someone told you that you need some type of entity structure. Maybe you're a truck driver. Maybe you even want to invest in a rental property, and you want to get an LLC for asset protection. Well, if that's the case, today we're just going to go over the top 5 tax strategies for LLCs to put you in a better position. Startup cost and organizational cost. Alright, let's get this ball rolling. Startup and organizational costs are the first 2 items on the list. Startup cost and organizational costs are almost certain to be incurred by any new business owner. It's possible that you've already invested money in the marketing and advertising, or that you've spent money on training and coaching before deciding to start your business. Anytime you incur costs before you're considered operational, those costs are categorized as startup cost and operation cost, depending on the circumstances. As a business owner, you have the ability to deduct $5,000 from your revenue in the first year as a startup or organizational cost, whichever is greater. Take, for example, the scenario in which you invest more than $5,000 in the establishment of your company. Anything more than $5,000 is deducted from your account and amortized over a period of 18 months. As a small business owner, you will still continue to reap the benefits of some of the expenses that you incurred that exceeded $5,000. Maintain strict awareness of this and ensure that when you file your tax returns, you take into account all of your startup costs, along with the cost of maintaining your small-based business's organizational structure, the home office deduction. So, let's move on to number 2, which is the deduction for a home office. In the year 2019, we were confronted with a pandemic, and if you're reading this right now, it's likely that you were one of the people who lived through it. Consequently, let's talk a little bit more about the tax deductions that are available to you as a small business owner. The home office deduction is one of the most valuable tax write-offs available. The majority of small business owners work from their homes. So how do we go about taking advantage of the home office deduction? Well, It's simple. If you have a designated space in your home or a designated room in your home where you can conduct business exclusively and where you keep all of your business records and paperwork, you can use that space as a home office and deduct the cost of that space from your taxes. So here's how it works. First, you need to determine the square footage of your home office space, also known as your home office space. Following the calculation of your home's total square footage, you'll divide your home office space or your home office by the total square footage of your entire home to arrive at your home office or home office space. Following this calculation, you will be given a percentage which will be your home office percentage, which will be calculated based on the utilities that you have in your home. Utilities include like water, cable, electricity, and gas filling stations. Every one of these items is included in your home office expenses. Additionally, whenever you make repairs, perform maintenance, or make improvements to your home office, these can also be included as a part of your home office expenses. As a result of some of the changes that they intend to make in their home as part of their home office, business owners can reap additional benefits. Vehicle deduction. The vehicle deduction is the third item on the list. Your vehicle will almost certainly be used for business purposes if you're a small business owner who travels to meet with clients. How do we go about ensuring that the vehicle you use to conduct your business is leveraged in the most effective manner? A vehicle deduction can be claimed in your LLC in two different ways, depending on how you structure your business. To do this, one option is to use the mileage calculation method. If you're a business owner in the year 2019, you will be able to collect 58 cents for every single mile you drive. For many Uber, Lyft, and truck drivers, mileage is extremely important because they're tracking their mileage on various different apps such as MileIQ or even QuickBooks, which has a way for you to track your mileage on your mobile device. It's critical to be able to track every business mile you travel. It's necessary to do this so that you can claim all of your deductions. Consider the fact that you're paying 58% for every single mile you drive. This can add up very quickly. The second method for a business owner to claim a vehicle deduction is to depreciate their vehicle while it's being used in the course of their business operations. The depreciation of a vehicle occurs over the course of 5 years. For example, if you purchase a vehicle for $50,000, you will receive a $10,000 write-off each year if you used a straight-line depreciation method. There are several methods for depreciating a car. One method is the double declining method, which allows you to accelerate a portion of your depreciation. Another method is the single declining method. As a result, you will receive a greater tax deduction for your vehicle rather than having to wait the entire 5 years to receive the full amount of $50,000. There's also Code Section 179, which allows you to deduct the cost of a vehicle that weighs more than 6,000 pounds from your taxable income in a single tax year. For example, if you purchase a vehicle that weighs more than 6,000 pounds, you can write off the entire vehicle in your business through your LLC in the same year that you purchased the vehicle, reducing your taxes immediately. Let's move on to the next number, which is lowering your taxes. Let's talk about marketing and advertising for a moment. No business can function properly unless customers enter through the front door. In order to be successful in business, whether you're selling services or providing products, you'll need to market those services or advertise those products. Marketing and advertising are two of the most significant expenses that most business owners face, as they are the primary means by which you can generate a consistent stream of revenue within your organization. When you have marketing and advertising materials going out, whether it's flyers, a website, or SEO, this is a business expense that you can deduct from your profits every year through your limited liability company. When you spend money on marketing and advertising, these are expenses that must be paid immediately. These expenses don't need to be amortized or depreciated over time. They can be written off immediately. As a result, rather than depreciating marketing and advertising expenses over a 5-year period, you can depreciate marketing and advertising expenses in the year in which they are incurred. As long as they are not considered startup organizational costs, you will have no trouble deducting 100% of your marketing and advertising expenses incurred through your limited liability company, turning your LLC to an S corporation. And finally, but certainly not least, number 5. Changing your limited liability company into an S corporation. When your company grows to the point where the benefits outweigh the cost of converting your LLC to an S corp, you will no longer be subject to the 15.3% self-employment tax that many LLCs and sole proprietors are required to pay into the government. To mention the fact that you will be able to deduct your payroll expenses if you decide to put yourself on payroll because an S corporation requires that the business owner pay themselves out of the profits generated by their enterprise. That being able to control the income you pay yourself as well as the income at which you pay taxes is one of the many advantages of being a business owner. When you form an LLC, one of the many advantages is that you have the option of electing to be taxed as an LLC, an S corporation, or a corporation. However, one of the advantages of taxing yourself as an S corporation is that the self-employment tax is eliminated, and as a shareholder, you are able to claim a payroll tax deduction for your business expenses. That's it for this video, Laptop Lifestyler. Remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon!